All right, so we just survived another Bank of Canada announcement. It looks like now we have received our fourth consecutive announcement by the Bank of Canada in which they have paused rates or left rates at the same level, which is excellent news. And I think everybody involved in real estate, or maybe anybody involved with the economy, including all 40 million Canadians, will be really excited to hear this news, as things seem to definitely be stabilizing. So we're going to get in and talk about this a little bit more in this podcast. I've got none other than Jason Fen, managing partner from Outline Financial, here to break down what happened earlier today in the Bank of Canada's announcements and what impact that will have on the Toronto real estate market. And if you don't know me, my name is Ralph Fox, and I am the co-founder and broker of record of Fox Marin. Please be sure to hit that like or subscribe button. And if you have any constructive comments, we would absolutely love to hear from you. So let's get into it. Jason, so happy to have you here today on this momentous day of January, I believe it's 24th, 2024.
Yeah. Thanks for having me again. Definitely great news to hear that the Bank of Canada stood on the sidelines. They acknowledged that the economy is slowing, but did mention that inflation, core inflation, is proving to be a little stickier than expected. And as they have in their last few announcements, even though they left things flat, they did leave the door open. However, just a crack that they are resolute in keeping inflation or making sure that inflation is in check. I don't think anyone thinks we're going to see anything other than a rate cut being the next move, but they, definitely, left the door open that if things continue, if inflation continues to climb, that they could raise rates. Again, that's not something that anyone's expecting. I think the big conversation is when. When are we going to see rate cuts? And there was some conversation that it might be March, now, April, or is it into the summer, Q2, maybe into Q3? At some point, it does look like there's a rate cut coming. But I think just seeing, the CPI numbers last week coming in a little higher than expected, I think we should definitely temper expectations on when we will see the first cut. Again, the market is pricing in that we will see cuts this year. I just don't know if it's going to be March or if it's going to be a little bit later on in the year.
It's interesting because when the Bank of Canada came out today and made their statement, I was a little surprised. I didn't think that they were going to increase rates, so I'm not surprised with the outcome. Yeah. I thought that they would still be a little bit tougher talking than they actually were. A lot of the tone in their language has shifted more so while leaving the door open to potentially raising rates. They were a lot more dovish than in some of their past statements. So there definitely has been a shift in their tone. And I think, they're much more open to talking about shifts in the economy slowing down and rates coming down in tandem. So I think that is really, really interesting, just because it's more so, and it's interesting, especially in the US, when Powell comes out, there are theories about what color tie he wears or what type of shoes he's wearing, and that can move markets. But the subtext on this was really interesting, and there has been a definitive change, I think, in their approach and tone. So I think that is also very hopeful, given the fact that I believe, anyways, that the economy is a lot weaker than most people are aware of.
Agreed. And, we've witnessed, I guess, if you want to look at it, going back to like October, November, a peak, essentially, there was some conversation in the fall that we could potentially see another hike that obviously subsided. And keep in mind that fixed rates are tied to, loosely to what bond yields are doing. And yields are basically a forward look at what the expectation of the Bank of Canada is going to do with the overnight rate. And October, November, that was kind of the peak. And so we've seen yields fall. Since then, they spiked up over the course of the last couple of weeks with, what's going on in the US, the employment numbers coming in a little hotter than expected, and then CPI coming in a little, higher than expected in Canada. But overall, they're down substantially from their peak in the fall. When we look at that, what that has done is, in advance of variable rates coming down, we've started to see fixed rates come down. There's two big wins out of that. One is that, from an affordability perspective, if you're looking at where someone qualified in, say, October to where they're qualifying today, there's a pretty significant improvement in the amount of mortgage that someone would qualify for.
You have a pretty good chart on that.
Yeah. So I just took, someone, a household income of 150K,
Right.
borrowers with 20% down, no debt. And just for, running some numbers, I used where the 3-year fixed rate was in October, and it was at 6.61%. And then I compared that to, a 3-year fix today at 5.49%. And if we look at, where that borrower would have qualified in October, they would have qualified for a mortgage of about $568,000, which would have been 80% of a purchase price of $710,000. So if we fast forward to today, look at a rate of 5.49, that same borrower now qualifies for a $630,000 mortgage, which is a purchase price of $787,500 with 20% down. So when you look at that, that equates to an 11% increase in purchasing power.
Significant.
Yeah, absolutely. Absolutely. We've had a lot of borrowers, our potential buyers that have been coming out of the woodwork over, the last couple of weeks. Or I'd say, since Jan 1, looking to, update pre-approvals. And then also seeing rates with a 5 in front of it versus a 6. I think that's also, plays into the psychology of the buyer that, people are a little bit more comfortable in starting to re-engage and look at the potential for making a purchase, and seeing rates trending down versus, hitting a peak. That 6.61% for 3 years is the highest rate that I can remember in the last, 20 plus years.
Awesome. Awesome. And so one of the things that I think is really interesting is when you're thinking about, well, what the future could hold for the Toronto real estate market is if you look at how the market was performing when it was performing very, very well last April and May,
Yeah,
in terms of price surges. I mean, we're not talking that big of a differential now between 5.5 or 5% into the low fours to see how the market would behave. And I think once we get into the fours, even though that's much more elevated than the way we're operating in 2021 or into early 2022, it shows you what the potential demand that's being pent up with could jump back into the market very aggressively once we get into the fours, and that affordability comes down, and then prices in turn will shoot back up to balance that.
for sure. And I think 4.99 looks a heck of a lot better than 5%. That
Yes, it does.
The optics of that 4.99 definitely play into a lot of buyers' minds. And yeah, to your point, April, May, a lot of clients pre-approved and then bought and transacted in like June, July. That was the busiest point of the year last year. And then obviously, we saw interest rate hikes in June and July, and, possibility of further cuts or increases, as we move throughout the year. And that really put a damper on the market. So if we do see rates continue to drop, as they're expected to do over the course of the year, I think you're going to see a lot of people move off the sidelines. And, I guess, at some point, it gets into that, is supply going to be a big problem again? And what that does to prices, are we going to see prices rebound? And I think once we do see rates come down and, we do see rates with a 4 in front of them pretty consistently, I think we're going to see the market pick up quite a bit. That's my take on it.
For sure. And I also think there's a lot of sellers sitting on the sidelines, either for properties that didn't sell towards the end of 2023 or people who are waiting for better market conditions. So I think we could see an influx both of buyers and new listings this fall. So it could be very, very active, having just come off the least amount of transactions since 2001 in the GTA. We might see a much greater swing towards the other side, sort of like a pendulum now swinging all the way across very quickly. So definitely will be an interesting start to the year. I'm so looking forward to one day getting to a point where we don't have to pay attention to these Bank of Canada announcements like we did the last 17 years prior to all of this. So it'll be really nice just to know that the market is at a stable position and people have the comfort of just making decisions based on certainty versus the uncertainty that we've been playing in for the last year and a half.
I said, we talked about that before about the average Canadian, didn't even know what inflation was or looked at GDP or employment numbers. And now it's like, it's like a big event that everyone tunes in, right? That has a meaningful impact, right? So
we had our team meeting this morning and every single person was looking at their phones knowing at 9:45 a.m. That's when the announcement was going to come out. And I can't remember prior to the last year and a half when that was ever a big factor
Totally.
in terms of day-to-day decisions. And so I think this will even bolster more confidence. It's still early into 2024, but we are seeing a lot more positivity in terms of sentiment, both buyer and seller sentiment about what's ahead this year. And we've seen, especially in the last week, an uptick in activity as I think people are starting to realize that we are at the end or coming too close to the end of this cycle.
Totally.
And so I think people are trying to take advantage of that before the market starts to really heat up.
And I think the other consideration is, okay, the one part I mentioned was, yes, you qualify for more mortgage. But how about those people that aren't worried about qualifying for more mortgage, but just looking at monthly payments? We're seeing an improvement just when we're looking at an interest rate drop of, more than 1%, it significantly reduces your monthly expenses as well. So that's also pulling people off of the sidelines. So it's not even necessarily that people qualify for more. It's just people that, are looking at dollars and cents and
it's also a scale, right? Because if this is interest rates, as interest rates come down, things look more affordable, but then it starts to pull it directly the other way.
Totally.
So really, really interesting time. Okay. And what do you think the future holds for the next few months? Like what are you advising your clients on in terms of interest rates, inflation, and what to do if you're considering making a move in the market in the next 2 to 3 months?
So I think you definitely want to make sure that you get pre-approved. The path to interest rates going down could be a little bit of a roller coaster. Not to say, again, we're going to see any changes to the overnight rate, but fixed rates may slightly tick up before they come down. They may go up, go down. I always suggest you lock in and make sure that you've got your worst case scenario mapped out. So on top of holding an interest rate, which you can hold for 4 months, it also makes sense to just make sure that, if you do find the right place, you're not starting from zero when you do find that place to make sure that you're in a position to buy. You've already done all the legwork so that you could realistically move confidently with making an offer. And I think that, if you're able to strike in this market, it's the best position to put yourself in. So we always suggest that even if you're thinking about it, whether it be in the next 3 months, 6 months, or 12 months, that you do reach out and make sure that you're getting yourself pre-approved. As far as looking at interest rates in terms, I'd say that a large portion of our clients are opting for shorter term fixed or opting for a variable rate. Very few clients seem to be opting for like a 5-year fixed rate now, with the expectation that interest rates are going to drop over the kind of the short to medium term. Locking into a longer term fixed, the way that the penalties are calculated definitely skew in the favor of the bank. So, if you're thinking about, taking a 5-year fixed, you're likely going to be stuck with that rate for the next 5 years, because if rates do drop down and you do want to renegotiate, sadly, any interest savings would be negated by the penalty that you pay. And that holds true the longer you go from a fixed rate perspective. So I'd say a large portion are still opting for some stability. The hangover of the last 2 years with the variable rates increasing so much, it's still in the back of a lot of borrowers' minds. So a lot of clients opting for shorter term fixed, so 2 or 3 years. The other consideration is that for a lot of variable rates right now, when you're approved for a variable rate, you're approved for a discount off of the prime rate. So prime is 7.2%. In most cases, we typically see variable rates that are 0.8 to 1% below that. And over the last 6 months, the discounts on variable rates haven't been as aggressive. So you have a lot of clients that are being approved only for prime less 50 or prime less 60 on a variable rate. So a lot of those clients are still, maybe pro variable rate, but with the discounts being where they're at and then being stuck with that discount for 5 years. If you do take a variable rate today, they're opting for a shorter term fixed, see where rates go, and then potentially look to hop into a variable rate once things settle a little bit.
Awesome. Well, I think that pretty much sums it up. Jason, is there anything else that you want to bring up or talk about relative to what happened today and what you see happening in the market currently?
I think the other consideration, and we talked about this, Ralph, before, was looking at renewals and the concern with renewals. And I think there's a couple considerations to keep in mind. We are looking at some stats from the big banks, and they had released some data on renewals. And if you're
Yeah,
looking at it,
this is actually really interesting
yeah,
because everything you are reading in the news and a lot of the media is talking about this renewal wall that's coming down the pipes that's going to crush everything because all these people aren't going to be able to afford their properties and are going to have to sell. And you and I know that that is not the case, but I'd love to sort of hear you
sure.
walk us through that.
Sure. So I think the first consideration is a lot of these mortgages are up for renewal that would have, either, renewed last time or purchased in 2019 or 2020. So right off the bat, if someone was in a situation where they were unable to qualify and they needed to sell, there's a pretty significant buffer from an equity perspective built into most houses in the GTA. I think we can both agree to that, even with any pullbacks that we witnessed over the last little while. The amount of growth we witnessed over the last 5 years compounded is pretty significant. So I think that there's very little risk as far as someone having negative equity in their property if they bought 5 years ago. It might be true in places outside of where we transact in the GTA, but as far as being in the GTA, I think it's pretty safe to say that. So those borrowers are likely in a position that if they needed to sell, they could. But if you look back to 2019 and 2020, a lot of those borrowers, they're definitely going to see a significant increase in interest rates. Most 2019 mortgages would have been anywhere between 3.5 and 2.75, I think, by the end of the year. So somewhere in that range. Now, the big consideration is all of those mortgages were stress tested at a rate of 5.19 to 5.24, which is pretty much in line with where interest rates are today. So, in theory, all of these borrowers have already qualified at interest rates that are similar to where they're at today. And I know that the stress test took a lot of flack when it came in, but I think we can both agree that it served its purpose over the last couple of years. And I think, it helped keep people in check from taking on more debt than they should have. And so I think, we're looking at most borrowers, again, being in a position where, in theory, they should be able to qualify. Not to say that someone hasn't added any debt over the last 5 years, but everyone that is coming up for renewal has already qualified based on rates where they're at today. Now, there are options in the event that clients do want to look at, if their payments are going to be too high when they reset, and you can always amortize your mortgage. Obviously, no one wants to add years to their mortgage, but we're in some pretty unique times right now. So, if you started out at 30 years, you've paid yourself down to 25 years, you could refinance back out to 30 years, at least short term. So there are some options. And, I think we'll probably see a lot of clients opting for shorter term fixed that are up for renewal and praying that we do see lower rates over the course of the next couple of years. But, I think there's a lot of talk about this renewal bubble bursting. And I think that a lot of it's unwarranted. I think one of the big concerns is obviously, if you look at the economy, there definitely will be a lot less disposable income. That's just the reality of it. And, how that impacts the economy with people having less disposable income. But again, in theory, people should be able to pay their mortgages based on how they qualified when they originally purchased their home.
And also, as we've seen, two things really to add to that. Number one, banks are very helpful in working with homeowners and investors because they don't want to become sellers of last resort by extending out amortizations. And also, I think you've seen people who own real estate in Toronto know how hard they've worked to acquire that real estate and also know what the potential future value of it is. And I think they would be very reticent to actually consider selling under duress while having the ability to continue owning the property. And if they have to make cutbacks on going out for dinner or going out for, on a vacation or buying the next iPad, that's where they'll cut back. And that comes right back to your disposable income piece, which could affect the economy and then maybe in turn affect jobs. So it's a whole interrelated thing, but we haven't seen forced selling and bank liquidations are at basically an all-time low. So I don't really think we're going to see that uptick that the media is talking about because it hasn't happened yet. And for the same reason why it hasn't happened, it doesn't look like it's going to happen in the future.
And someone would sell their place before allowing it to go to foreclosure.
For sure they would.
Yeah.
But we're just not seeing it.
Agreed.
And I don't think we will. So that's awesome. Jason, I want to wrap this up. I want to keep this quick and short. I'm so glad that you were able to jump on this podcast pretty quick, short notice to be able to just talk about what's happening and what we foresee happening in the future. As always, I really appreciate it. Where can people find you?
So outline.ca is our website, and I can always be reached at jason.friesen@outline.ca if you have any questions. Thanks again for having me. I always love hopping on this on the podcast.
Always a pleasure, Jason. And thank you so much for tuning in. And again, if you like this information, if you have any questions or comments, please be sure to reach out to us. We love hearing from you. And don't forget to smash that like and subscribe button.